Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, to discuss plunging volatility indices. We'll also take a look at the 10-year and why other stocks in this stock market do matter. Steve, it's great to see you as always. Welcome back to Trade Talks. And it seems as if the market is really digesting well the macro news that we saw this week.
Yeah, this was in many ways like almost a perfect storm for people who've been looking for a break in I hate to say higher for longer, but even high for longer is more my theme. But if you're looking for some breaks in the fever that we had in rising bond yields, if you're hoping for some liquidity coming down the pipe from the Fed, both the FOMC meeting and this morning's employment report gave us hope. I think, markets that might have unduly fixated on Chairman Powell's use of the word done. I think it was more in context about not raising rates. And I think the market sort of extrapolated that maybe toward cutting rates, which I don't know that one follows the next. But after this morning's employment report, we are seeing rate cuts being priced in as early as June, which had been priced in as early as July. We're seeing probably about call it a 25-30 basis point reduction in year-end 2024 rates, which is being reflected in lower two-year note rates this morning. And as we know, lower bond yields generally, and of course, easing monetary conditions, good for stocks, and we're certainly seeing that reflected today.
Yeah, and we're certainly seeing it in the movement in bonds, to your point earlier. But I want to discuss something, in addition to how the market's looking at bonds being cut in the latter half of 2024. I mean, that's a narrative that has been out there. It doesn't feel as much of a surprise to me. But another thing that you and I have been discussing is the concentration in the number of stocks that have been moving the market. And to your point in your note this morning, there are other stocks and other ideas out there that are taking place in the market.
Yeah, I mean, I think we kind of lose sight of the fact that we've been so focused on the mega cap tech stocks, and I don't, let's go beyond the Magnificent Seven, so to speak, but still, there's this whole big world out there of stocks beyond it, and we it's well known that most of the outperformance this year has really come from these 7 mega cap tech stocks, of which are all Nasdaq listed, by the way, and so Nasdaq is of course a big beneficiary of this. But I think it's important to recognize that we do need to keep an eye on what consumer stocks are doing. And even within that, there's been a big dispersion between the consumer staples and the consumer discretionary ETFs. And the reason for that is the consumer discretionary ETF contains Amazon and Tesla, whereas the consumer staples ETF doesn't. It's really all staple, basically your consumer stocks. And to me, there's no escaping the consumer. If the consumer is healthy, healthy or not healthy, the consumer is 2/3 of the U.S. economy, plus or minus. And so if consumers are spending money, the economy's fine. If consumers are not, the economy's in trouble. And so we really do have to keep an eye on the other, on the other 93 stocks in the Nasdaq 100, on the other 493 stocks in the S&P 500. It's crucial that we do this because we need to get our signals not from a small list of stocks that actually may be narrowing in leadership, and really think beyond that.
It's interesting. I find it confusing that Tesla is in the discretionary ETF that you had mentioned. I mean, I get Amazon, right? Amazon makes sense there, but there are other auto companies, and I get Tesla's valued as a tech stock. I understand all of that, but there are other auto companies that are discretionary items as well. It's just very curious that Tesla is in there and there's other discretionary companies that aren't.
Yeah, it's a bit odd. I mean, because certainly buying a new car is less yes it's discretionary, but it's more of a capital goods item. It's hard to think of it that way. I guess it's probably just the best place for it because ultimately it is a discretionary purchase from consumers, although an obviously very expensive one, and one that's certainly hardly a regular purchase for most people. But my bigger worry now is that Tesla's recent underperformance, I think that it's kind of in danger of being kicked out of the Magnificent Seven. And my worry there is what happens if the Magnificent Seven shrinks? What happens if it becomes the Big Five or something of that nature? That to me is a big concern. not one that's immediate right now, but one that I have to think about going forward. The other concern I have right now is looking at Apple's earnings. This is their fourth consecutive quarter where revenues were lower on a year-over-year basis. Is that a growth company at this point? It's being priced as a growth company, but if the market decides that Apple is a value stock, which it certainly is by any criteria, but if Apple is a value stock that's being priced like a growth stock, that'll be an interesting, reckoning for the market. Not one that's immediate, but one that I think we have to start to think about, at least in the backdrop going forward.
Yeah, well, it's so interesting with Apple because it's also a special situation in a way where it has exposure to China, and that's such a big part, of Apple's story, if you will. So, thinking about it in terms of where they're going to, if they, decide to shift supply chains and manufacturing, I feel like there's just so much exposure to that name. Starbucks is another one, Nike is another one. I feel like it's such a big outlier with what's happening with China. So it feels as if a lot of the underlying stories of these names are shifting as well.
Absolutely. And, especially when we bring up China into the discussion, I think the market has at least come to terms with the fact that the big boost that we would get from China coming back online post-COVID hasn't happened. The Chinese economy has been, by pretty much every measure, a disappointment. And we have to wonder whether it becomes a headwind going forward or just sort of background, something that's out there in the background not helping. Right now, I would say it's not helping, although it's certainly putting a drag on certain stocks that have big China exposure. But, when we think about how China really, I would say, has a huge hand in dragging the world out of the global financial crisis, because they were really the engine of growth. What happens if they go into retrograde? And how does that affect both the global economy, but also, the stocks among the ones you mentioned, which are very dependent upon China, either for supply or demand?
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.